Nupur, it does seem like as investors, they should look beyond November. And if you take a longer term perspective, then it is risk on. It is Fed lower for longer, and that is enough to support the rally.
Yes, absolutely. I think, again, both monetary and fiscal policy, we have seen it be extremely supportive. And yes, you will see some volatility over the next 1 month. But at Eastspring, we think that the risk-on position is still on. Equities still look undervalued. The technical correction that we saw of global equity markets in September actually sets us up for a pretty decent rally into year-end. And earlier, we were seeing an improvement in fundamental economic data just from the U.S., but it's expanded out into other emerging markets as well. If you look at Latin American economies in particular, equities in Brazil and Mexico are down, between 25 and 40% year to date still, so lagging really behind the rest of the world. But economic activity and data is surprising to the upside there, and earnings expectation forecasts are to grow at a pretty healthy pace by almost 50%. So it seems like you do have, strong fundamental data backing the fact that you would see a rally into year-end. Of course, volatility will continue, and so from a portfolio context, we are trying to remain as diversified and nimble as possible, but on the whole, still pretty risk-on.
So in terms of where to put your money, equities over bonds, Asia over the rest of the world, would that be a fair assessment?
So equity over bonds for sure. Asia, I would say, has probably done a large part of its rally already. We've seen that in China. We've seen it in Korea and Taiwan. We've actually, repositioned slightly more towards Latin America for the reasons I just mentioned. It still seems like a laggard, and the value opportunity seems to be in the LATAM space within emerging market equities. But overall, U.S. equities are still attractive. But again, you have to be quite selective by focusing more on the deep cyclicals, which have been lagging the market year to date. But overall, definitely equities over bonds.
And how are you viewing in terms of value over growth? I mean, the value side has really been a pain trade of late here. But it's not just people are trading on growth prospects now, but something more tangible. We're seeing that earnings, at least, are looking a little bit better in terms of earnings upgrades. Do you think that can actually lead to outperformance now? Is this time really different, Nupur?
Yes, that's really, Yvonne, that's really the question of the decade. Value has been a perennial underperformer, and we think that if we really want to see a sustained outperformance of value, you need to see yields increase. You have seen 10-year bond yields literally be on a downtrend for the last decade. And really, even though economic growth and economic activity has picked up, 10-year bond yields are still well below 1% and well below the levels that we saw in January. So for value to pick up, we think yields need to rise. There are certainly some opportunities within value sectors. So for instance, if you look at the U.S. Equity market, then financials still pretty deeply in the negative year to date, and earnings are starting to pick up for U.S. banks. So we think that certain value sectors like financials and even industrials do present some opportunities. But to call it a blanket value versus growth is probably probably too early to do that. But you can definitely be selective and pick certain stocks and sectors within the space.